Hi everyone. So today we will understand what is debt to capital employed ratio. So many of the students ask about this question, and that is why today we will going to discuss. So the debt to capital employed ratio. So please note that this ratio is also part of the solvency ratio. So solvency ratio is the major heading type of the heading or type of the ratios where debt to equity ratio is coming. Okay, debt to capital employed, debt to equity, all those ratios are coming under the solvency ratios. So from the name only you can identify that the formula is to calculate debt to equity is debt to capital employed. Now what is the meaning of debt? So here debt means only debt long term debts. Now when practical question come, you may get confused that in practical question it could be mentioned that long term bank loan is suppose 10 lakh, other long term loan, other long term, okay, rupees 2 lakhs, or you can say it could be mentioned over here that like other long term provisions. Okay, so long term provision also could be mentioned in the question. So when you calculate date, you have to consider all these part. Okay, whatever non-current portion mentioned in the questions, all these things you have to consider. Now, what is the capital employed? So capital employed is basically you can calculate equity, total equity plus long term loan, long term loan, or you can say long term liability. Okay, so these are the capital employed. In other way you also calculate capital employed is total asset minus current liability. Okay, so you will get capital employed. So by applying this formula you will come to know what is the debt to capital employed ratio. So as like debt to equity ratio, this ratio is also used by the lender of the fund, or you can say banks, who actually whenever they make new kind of the investment they try to find out what is the debt to capital employed ratio. The lesser is that ratio, more fund is secure. Okay, so bank whenever they calculate, if they find this ratio below 1, then they feel that okay, our fund will be safe in this entity, and that is how they identify. Okay, so significance is basically this proportion of long term debt in the capital employed. Low ratios provide security to the lender, high ratio helps management in the trading on the equity. So hope you understand the situation that okay, this ratio also understand or use by the lender or investor. So whenever they make try to make new investment, they first calculate this capital employed ratio, and from this ratio they will came to know whether our fund will be secure or not. Okay, and there is one another theory is also mentioned that okay, you can calculate this debt to equity ratio, debt to capital employed ratio with. So whenever you apply debt to capital employed ratio, so debt, this is the another method, so do not get confused. Okay, this is another method where how you will calculate debt. So you will calculate debt would be non-current liability plus current liability. Okay, and total asset is capital employed is basically total asset. So here capital employed is basically total asset. So this is the another method also provided in the books, but uh, this is alternate method. So in exam perspective, examiner would definitely ask specific things how you can calculate, but this is the another method where investor uses. So they, when they say date, it means current debt, current liability plus non-current liability, and capital employed means total asset. So this is how we will calculate this formula. Hope you guys understand the formula. Thank you very much.